What if the economic stability you've been promised your entire life was built on a foundation that's already cracking? Most people think the current financial system is solid. They see interest rates rising and falling. They hear about bank problems being resolved. They watch governments manage debt. And on the surface, that's true. But what if those surface movements are masking something deeper? 7 distinct patterns are converging right now. Patterns that have appeared before in history. Patterns that signal not just recession or inflation, but fundamental restructuring. The scale is staggering when you look at the actual numbers. Global debt has reached $111 trillion. That's 94.7% of everything the world produces in a year. Central banks have reversed decades of policy in less than 36 months. The dollar's share of global reserves has dropped from 85% to 58%. And commercial real estate, the physical infrastructure of the modern economy, is facing losses larger than the 2008 financial crisis. This isn't a crisis, this is a reset. Let me show you how the architecture works. The world most people understood ended in March 2020. That's not hyperbole. That's when the mechanisms that had governed global finance for 40 years stopped functioning according to their original design. On March 15, 2020, the Federal Reserve cut interest rates to zero. Within weeks, central banks worldwide followed. The European Central Bank, the Bank of Japan, the Bank of England, all implementing emergency measures not seen since 2008. But this time was different. In 2008, central banks bought $2 trillion in assets. By the end of 2020, that number had exploded to $9 trillion. Think about what this meant in practical terms. For 4 decades, since Paul Volcker raised rates to 20% in 1980, the global financial system operated on a specific logic. Central banks could control inflation through interest rates. Governments could borrow at manageable costs. Banks could earn profits through traditional lending. That entire framework assumed that money had a price, that borrowing had a cost, that risk carried consequences. March 2020 changed the equation. When the Federal Reserve's balance sheet went from $4 trillion to $9 trillion in 9 months, something broke. Not visibly, not immediately, but structurally. The International Monetary Fund recorded global debt rising from $226 trillion in 2019 to $251 trillion by 2024. The increase wasn't just in government borrowing. Corporate debt expanded. Household debt expanded. And critically, the relationship between debt and economic growth fundamentally shifted. In 2019, global debt stood at 235% of GDP. By 2024, despite 5 years of supposedly strong economic performance, that ratio barely moved. It takes more debt to generate the same amount of economic activity. That's not growth, that's dependency. Here's what most people don't understand about the mechanics. When a central bank cuts interest rates to zero, it isn't just making borrowing cheaper. It's rewriting the rules of capital allocation across the entire economy. In 2021, with rates at zero, $2 trillion flowed into speculative assets. Technology startups with no profits raised billions. Real estate prices surged 20% in a single year. Stock markets hit record highs. The logic was simple. If money costs nothing to borrow, and central banks are buying trillions in bonds, then the only rational strategy is to borrow as much as possible and invest in anything that might appreciate. Silicon Valley Bank understood this perfectly. Between 2019 and 2022, the bank grew its deposits from $62 billion to $189 billion. That's a threefold increase in 3 years. Where did that money go? Into long-term treasury bonds and mortgage-backed securities yielding 1.5 to 2%. The bank's executives believed interest rates would stay low indefinitely. They had reason to believe it. Federal Reserve projections in 2021 showed rates remaining near zero through 2024. Every major economist agreed. The head of the European Central Bank, Christine Lagarde, stated publicly that inflation would be transitory. Central banks had spent $9 trillion to prevent economic collapse. No one believed they would risk unwinding that support. But here's the trap. Every dollar of the $251 trillion in global debt was issued under specific terms. Interest rates, maturity dates, refinancing assumptions. When those assumptions change, the entire structure becomes unstable. In February 2022, U.S. inflation hit 7.9%, the highest level in 40 years. The Federal Reserve faced a choice: continue the zero-rate policy and watch inflation accelerate, or raise rates and stress a system built for cheap money. They chose to raise rates. Between March 2022 and July 2023, the Federal Reserve increased its target rate from 0.25% to 5.5%, the fastest tightening cycle in history. Think about what this meant for every borrower, every bank, every government that had assumed rates would stay low. A company that borrowed $100 million at 2% in 2021 now faced refinancing at 7%. That's not a 5% increase, that's a 250% increase in debt servicing costs. Multiply that across the global economy and the scale becomes clear. The International Monetary Fund calculated that developing countries faced an additional $921 billion in net interest payments in 2023 alone. That's money diverted from infrastructure, education, healthcare, redirected to servicing debt issued under the old assumptions. The pattern is unmistakable. This has happened before. In 1979, Fed Chairman Paul Volcker raised rates from 11% to 20% to break inflation. The result? A deep recession. Unemployment hit 10.8% by 1982, but the system survived because debt levels were manageable. Total U.S. debt in 1980 was $2.5 trillion, roughly 90% of GDP. Today, U.S. federal debt alone stands at $38 trillion, 125% of GDP. And that doesn't include corporate debt, or household debt, or state and local government debt. The economy is far more leveraged now than it was in 1980, which means the same policy tools produce vastly different results. Silicon Valley Bank was the warning signal. On March 8, 2023, the bank announced it had sold $21 billion in securities at a $1.8 billion loss. Within 36 hours, depositors attempted to withdraw $42 billion, the fastest bank run in American history. Federal regulators seized the bank on March 10th. 2 days later, they seized Signature Bank. By May, First Republic Bank had also collapsed. 3 of the 4 largest bank failures in U.S. history occurred within 2 months. The combined assets of these 3 institutions exceeded $500 billion. But here's what really reveals the depth of the problem. A 2023 study by Stanford economists found that 186 other U.S. banks faced similar vulnerabilities. Combined, these banks held $5.4 trillion in assets. The mechanism was identical across all of them. Deposits surged during the pandemic. Banks invested those deposits in long-term securities at low yields. When rates rose, those securities lost value. The losses didn't appear on balance sheets because accounting rules allowed banks to classify them as held to maturity. But Silicon Valley Bank's failure forced other banks to confront the same reality. Their assets were worth less than their liabilities. They were technically insolvent. They just hadn't admitted it yet. The Federal Reserve and FDIC responded by creating the Bank Term Funding Program, a facility that allowed banks to borrow against their underwater securities at par value. Effectively, taxpayers absorbed the losses. The program provided $163 billion in emergency funding. It prevented immediate contagion, but it didn't solve the underlying problem. The entire banking system remained structured for a low-rate environment that no longer exists. And then it got worse. While regional banks struggled with securities losses, a different crisis was building in commercial real estate. During the pandemic, office utilization collapsed. Workers shifted to remote or hybrid arrangements. Companies reduced their physical footprint. By the first quarter of 2025, office vacancy rates hit 20.4%, a record high. Higher than any point during the Great Financial Crisis. Higher than the 1990s recession. The highest vacancy rate in recorded history. But vacancy is only half the story. The real destruction came from the intersection of 3 forces: rising interest rates, falling property values, and maturing loans. In 2024, $929 billion in commercial mortgages matured. Another $950 billion will mature in 2025 and 2026. Think about what happens when a property owner needs to refinance. A building purchased in 2019 for $100 million with a $70 million loan at 4% now needs refinancing at 8%, and the building's value has fallen 30% to $70 million. The math is brutal. The original loan payment was $3.3 million annually. The new loan payment would be $5.6 million. But the property can't generate enough rental income because it's sitting 20% vacant. The owner faces 2 choices: inject tens of millions in new capital, or walk away. Morgan Stanley analysts predict office property values will decline 40% from peak to trough. That's worse than the Great Financial Crisis, when commercial real estate fell 35%. The difference is scale. In 2008, commercial real estate represented about 10% of bank assets. Today, regional and community banks hold $2.7 trillion in commercial real estate loans. That's roughly 60% of their total lending. When those loans default, the losses don't disappear. They flow through to bank balance sheets, to pension funds holding commercial mortgage-backed securities, to insurance companies that underwrote policies. This isn't just a real estate problem. It's a systemic shock moving through the financial system in slow motion. The pattern repeated in commercial mortgage-backed securities. In May 2023, delinquency rates began rising. By December 2024, CMBS office delinquency reached 11.01%, the highest level on record. Office delinquency rates in Q2 2025 rose to 7.2%, up 86 basis points in 3 months. Think about what this meant in practical terms. A pension fund holding $1 billion in CMBS suddenly faced $110 million in non-performing loans. That's money that won't be returned. Money that was supposed to fund retirement payments. A life insurance company with $500 million in commercial real estate debt just saw $50 million stop generating income. The Federal Deposit Insurance Corporation's risk review for 2025 explicitly warned that commercial real estate loans would continue to underperform, with deteriorating property-level cash flows, vacancy, and elevated interest rates as key risks. But the real crisis isn't the losses that have already occurred. It's the loans that haven't matured yet. Between 2026 and 2028, another $1.8 trillion in commercial loans will mature. Properties financed in 2016 and 2017 at the height of the previous cycle. Loans that assumed office buildings would generate stable cash flows indefinitely. Loans that assumed interest rates would remain low. Loans that assumed remote work was temporary. Every one of those assumptions has proven false. And when those loans mature, property owners will face the same choice. Refinance at punitive rates, inject massive new capital, or default. The wave hasn't crested yet. It's still building. No one saw what was coming. Or rather, no one wanted to see. But while Western banks struggled with rate shocks and commercial real estate losses, a different pattern was emerging on the other side of the world. In August 2023, the BRICS nations, Brazil, Russia, India, China, and South Africa, extended invitations to 6 new members. By January 2024, Egypt, Ethiopia, Iran, and the United Arab Emirates had joined. Saudi Arabia, one of the world's largest oil exporters and a longtime U.S. ally, was considering membership. The expansion wasn't just symbolic. It represented a fundamental challenge to the dollar-based financial system that had dominated global trade since 1944. In 2024, 90% of Russia-China trade occurred in rubles and yuan, not dollars. China and Brazil signed a yuan-real trade settlement agreement, bypassing dollar transactions entirely. India began purchasing Russian oil in rupees. These weren't isolated decisions. They were coordinated responses to a decade of Western financial sanctions. After Russia's invasion of Ukraine in 2022, the US and European Union froze $300 billion in Russian central bank reserves, removed Russian banks from SWIFT, the global payment messaging system, and prohibited dollar transactions with Russian entities. The message was clear. The dollar wasn't just a currency, it was a weapon. And if your country fell out of favor with Washington, your assets could be seized, your banks disconnected, your ability to trade crippled. The BRICS nations drew the logical conclusion: reduce dependence on the dollar. In October 2024, at the BRICS summit in Kazan, members discussed the development of BRICS Pay, a decentralized payment system for transactions in local currencies. China's cross-border interbank payment system, or CIPS, expanded to 4,800 participating banks across 185 countries. The yuan still represents less than 5% of global reserves, compared to the dollar's 59%. But the direction of change is unmistakable. Central banks worldwide increased gold purchases to 1,045 metric tons in 2024, the third consecutive year exceeding 1,000 metric tons. The National Bank of Poland led with 90 tons. Turkey added 75 tons. China's purchases, while not fully disclosed, likely exceeded 100 tons. Gold doesn't pay interest. It can't be frozen by sanctions. It can't be printed by central banks. It's the ultimate hedge against dollar dependency. And central banks are accumulating it at levels not seen in 50 years. President Donald Trump responded in January 2025 by threatening 100 to 150% tariffs on any BRICS nation that pursued de-dollarization. Brazilian President Lula da Silva, who had been among the most vocal advocates for a BRICS common currency, quietly dropped the proposal from Brazil's 2025 BRICS presidency agenda. The threat worked, temporarily. But here's what Trump's tariff threat reveals. The United States recognizes that dollar dominance isn't guaranteed by economic strength anymore. It requires political enforcement. For 70 years, countries accepted the dollar because U.S. markets were the deepest, U.S. institutions the most trusted, U.S. military power unmatched. That's changing. The U.S. share of global GDP has fallen from 40% in 1960 to roughly 25% today. China's economy, measured at purchasing power parity, already exceeds America's. The BRICS 10 collectively account for 37.9% of global GDP, compared to the G7's 27.8%. The economic weight that once guaranteed dollar supremacy has shifted. What remains is institutional inertia and political coercion. But inertia fades, and coercion breeds resentment. The parallel to the British pound is striking. In 1914, the pound sterling was the world's reserve currency. London was the financial capital of the world. Britain controlled the largest empire in history. By 1944, the pound was finished as a reserve currency, replaced by the dollar at Bretton Woods. The transition took 30 years. It wasn't caused by a single event. It was the cumulative result of 2 world wars, massive debt accumulation, and the emergence of a stronger economic power. The same sequence, the same outcome, the same pattern. But here's where the current situation is actually worse than previous transitions. The household sector is breaking. As central banks raised rates to fight inflation, the cost of debt servicing exploded across the economy. In the third quarter of 2025, total U.S. household debt reached $18.585 trillion, a record high. Credit card debt hit $1.233 trillion. Mortgage debt stood at $13 trillion. Auto loan debt reached $1.66 trillion. Student loan debt totaled $1.62 trillion. The absolute numbers are staggering, but the real crisis appears in the delinquency rates. Credit card delinquencies rose to 8.88% in the third quarter of 2025, up from 8.58% the previous quarter, the highest level since 2011. Auto loan delinquencies remained elevated across all credit scores and income levels. Mortgage delinquencies, while still low compared to 2008, were rising from pandemic-era lows. Foreclosure filings increased 5.8% in the first half of 2025 compared to 2024. Up 41% compared to 2020. Think about what this meant for the average household. The average credit card balance for households carrying debt was $10,815. At an average interest rate of 23.37%, if that household made minimum payments of 3% per month, it would take 22 years to pay off the debt and cost $18,000 in interest. That's assuming they never charged another dollar. The median household income in the U.S. is approximately $75,000. After taxes, that's roughly $60,000. A $10,815 credit card balance at 23.37% costs about $2,500 annually just in interest, plus mortgage payments, plus auto loans, plus utilities, food, healthcare, childcare. The math doesn't work. Households are servicing debt with debt, using credit cards to cover basic expenses, using home equity lines of credit to pay down credit card balances, using personal loans to consolidate higher interest debt. It's a cycle that only resolves 3 ways. Income rises dramatically, debt is discharged through bankruptcy, or the system resets. What came next changed everything. In September 2024, the Federal Reserve finally began cutting interest rates, a 0.25 point reduction, then another in October, then November. By December 2024, rates had fallen to 4.48%, still well above the 0.25% level of 2020, but moving in the opposite direction. The reasoning was straightforward. Inflation had moderated from 9% in 2022 to 2.9% by late 2025, close enough to the Federal Reserve's 2% target. The labor market was cooling. Job growth slowed significantly. The unemployment rate edged higher. The risk had shifted from overheating to stalling. But here's the trap. The Federal Reserve can lower rates. It cannot unwind the debt. Between 2020 and 2024, global debt increased by $25 trillion. That debt was issued under specific terms, at specific interest rates, with specific maturity dates. Lowering rates in 2025 doesn't change the fact that $2 trillion in commercial mortgages will mature in 2025 and 2026 alone, at rates far higher than the original loans. Lowering rates doesn't change the fact that sovereign borrowing in OECD countries is projected to reach $17 trillion in 2025, the most ever recorded. Lowering rates doesn't change the fact that 23 countries worldwide are already borrowing more than their entire GDP, and more than 3.4 billion people live in countries where net interest payments on public debt exceed spending on either education or healthcare. The Federal Reserve is trying to manage an impossible equation. Keep rates low enough to prevent mass defaults, but high enough to prevent inflation from reigniting. Support economic growth, but don't create new asset bubbles. Maintain financial stability, but don't bail out reckless borrowers. It's threading a needle that keeps getting narrower. The pattern is unmistakable. Every major economy faces the same trilemma. Manage inflation, service debt, maintain growth. Pick two. You can't have all three. Germany, the strongest economy in Europe, saw its debt-to-GDP ratio rise from 59% in 2019 to 63% in 2025. Japan's debt exceeds 230% of GDP, the highest in the developed world. Even economies previously held up as models of fiscal responsibility are drowning in obligations. And the response is always the same: issue more debt to service existing debt. The International Monetary Fund projects that by 2028, the expanded BRICS 10 will account for 37.9% of global GDP. The G7 will fall to 27.8%. Think about what that means for global financial architecture. The institutions that have governed international finance since 1944, the International Monetary Fund, the World Bank, the Bank for International Settlements, were all designed when the G7 dominated global output, when the dollar's supremacy was unquestioned, when debt levels were a fraction of current levels. Those institutions still operate as if it's 1990, as if the US alone accounts for 40% of global GDP, as if emerging markets are supplicants rather than creditors, as if the dollar will remain the reserve currency indefinitely because that's how it's always been. But history says the ending is different. Every reserve currency in history has eventually been replaced. The Spanish real, the Dutch guilder, the British pound. The pattern is consistent. First, the issuing country finances wars or welfare through debt rather than taxation. Second, the currency's share of global reserves begins a slow decline. Third, a new economic power emerges with a stronger growth trajectory. Fourth, a shock, a war, a depression, a financial crisis accelerates the transition. Fifth, the old reserve currency remains important but no longer dominant. The entire process typically takes 30 to 50 years. The dollar's share of global reserves peaked in the 1970s at 85%. Today, it's 58%. That's a 27 percentage point decline over 5 decades. The pace is accelerating. Between 2000 and 2020, the dollar lost 10 percentage points. Between 2020 and 2025, another 8 percentage points. At current trajectory, the dollar could fall below 40% of global reserves by 2040. So let's connect all the pieces. 7 patterns, each one individually significant. Together, they describe a system in transition. Pattern 1. Global debt reached $251 trillion, 235% of GDP, issued under the assumption that interest rates would stay near zero indefinitely. Pattern 2. Central banks raised rates at the fastest pace in history, from 0.25% to 5.5% in 16 months. Every dollar of debt became exponentially more expensive to service. Pattern 3. The banking system cracked. Silicon Valley Bank, Signature Bank, First Republic Bank. $500 billion in assets failed within 2 months. Another 186 banks remain vulnerable. Pattern 4. Commercial real estate entered a crisis worse than 2008. Vacancy rates at record highs. Property values falling 40%. $1.8 trillion in loans maturing between 2026 and 2028. Pattern 5. The dollar's dominance is being actively challenged. BRICS expansion, local currency trade, gold accumulation. The mechanisms of de-dollarization are accelerating. Pattern 6. Households are drowning. $18.585 trillion in debt. Delinquencies rising. Income barely keeping pace with servicing costs. The consumer base that drives 2/3 of economic activity is tapped out. Pattern 7. Central banks reversed course too late. Rate cuts beginning in late 2024 cannot unwind the debt accumulated over 5 years, cannot prevent the commercial real estate crash, cannot stop the slow-motion bank failures. This is the reset, not a single catastrophic event, but a decade-long restructuring of the global financial order. The dollar will remain important, but it will no longer be unchallenged. Debt levels will come down, but through defaults, not repayment. Asset prices will find new equilibriums, lower than the artificially inflated levels of the 2020s. Banks will consolidate. Regional institutions will disappear. The survivors will be fewer, larger, and more tightly regulated. Commercial real estate will be repurposed. Offices converted to residential. Retail centers redesigned. The physical infrastructure of the pre-pandemic economy adapted to post-pandemic reality. And through it all, the institutions that promise stability, central banks, governments, financial regulators, will continue managing the transition, preventing panic, absorbing losses, extending and pretending. The pattern says the process takes 30 to 50 years. We're only 5 years in. The evidence says we're not living in a world shaped by temporary disruption. We're living in a world shaped by fundamental restructuring, a restructuring that began in March 2020 and won't finish until the 2040s. 7 times this pattern has appeared in reserve currency transitions. 7 times the outcome was the same. The only question is whether this time will be different. The evidence says it won't be.